Warren Buffett started investing when he was just 11 years old. At first, he thought investing was simply buying and selling stocks to make a quick profit. He tried different strategies, including market timing and chart analysis, but soon realized these methods didn't work well in the long run, even if they seemed entertaining. Then he discovered The Intelligent Investor by Benjamin Graham, which profoundly shaped his thinking. This book taught him that investing is much more than buying and selling. It's about understanding the true nature of businesses and how to value them. Benjamin Graham laid out 3 key principles. 1. A stock is not just a piece of paper, but ownership in a real business. 2. Investors must be rational and not let emotions drive their decisions, especially during market fluctuations. 3. Stocks should be bought at prices significantly below their intrinsic value, a concept known as margin of safety, to reduce risk. This philosophical framework became the foundation of Buffett's successful investment career. If you're serious about building lasting wealth, hit the like button now and subscribe to get more insights straight from the world's greatest investors. 2. Understanding stocks and the market. Buffett believes the biggest mistake investors make is viewing stocks as just numbers moving on a screen. He advises investors to think of a stock as a piece of a real business with assets, employees, customers, and competitive advantages. He uses the fictional character Mr. Market to illustrate market behavior, a daily salesman who offers prices that swing wildly between extreme optimism and despair, often disconnected from the company's actual value. Buffett emphasizes that stock prices are volatile and can be irrational, but a company's true value changes slowly and depends on real factors like earnings, growth, and competition. For example, the land a company owns doesn't suddenly change in value, even though its stock price might jump or fall dramatically due to market noise or rumors. 3. How to value a business. Buffett explains that valuing businesses is challenging but essential for every investor. He recommends reading company annual reports carefully without looking at the stock price first, so you can evaluate the business objectively. He asks, if you were evaluating a company without knowing its stock price, would it show stable profits, consistent growth? Does it have a competitive edge? It's like betting on a horse race after studying the true odds rather than guessing blindly. He also explains the margin of safety. Never buy a stock at a price close to its real value. Instead, wait for prices to drop well below intrinsic value, providing protection against unforeseen risks. 4. Choosing companies to invest in. Buffett poses a practical question. If you were given $1 million to invest in just 3 private companies, how would you choose? He focuses on businesses with durable competitive advantages, such as patents that block competitors, strong brand loyalty, or prime locations. He calls these castles with moats, companies protected from competition by a deep moat. He warns against buying companies that might be popular, but face fierce competition that threatens their earnings and stability. He also stresses the importance of honest and capable management, because poor leadership can destroy value even in good businesses. Are you ready to spot companies with real moats? Subscribe now and turn on notifications so you never miss a strategy that can grow your portfolio safely. 5. Personal investment strategy. Buffett advises investors to maintain strict criteria when selecting stocks. He says, don't invest in anything you don't fully understand, don't try to be smarter than everyone else, and patience is the key to success. Investing is not a sprint but a marathon, waiting for truly worthy opportunities to arise. He recommends the best investment is in companies you know and trust. He also cautions that the scarcity of good opportunities doesn't justify rushing into bad ones. 6. The importance of avoiding unsuitable companies. Buffett suggests a reverse approach. Instead of trying to pick the best stocks, start by eliminating companies that don't meet your criteria. This filtering reduces the number of choices and helps you focus on what really deserves your time and money. He advises avoiding sectors that are hard to understand or extremely volatile, like automobile manufacturing or tech companies without proven business models. He believes focusing on sustainable companies with strong track records is far better than risking investments in unknown territory. 7. The importance of understanding a company's cash flow. Warren Buffett emphasized that one of the most crucial things investors should focus on is a company's cash flow. He said, "Earnings are just a number, but real cash flow determines a company's ability to grow and pay dividends." He added that companies generating steady and strong cash flows tend to withstand crises better and invest in future opportunities. For this reason, Buffett advises investors to focus on companies with solid financial footing and positive cash flow. 8. Warning against excessive debt and its risks. Buffett warned about the dangers of excessive debt in companies, especially during tough times. He said, "A company that can't easily repay its debts is at risk of collapse, even if it shows profits." He pointed out that a smart investor avoids companies burdened by heavy debt and seeks those managed with financial discipline, using debt moderately rather than as a survival tool. 9. The importance of good management in a company. Warren Buffett stressed that strong management is the cornerstone of any successful business. He said, "A great product can fail if the management is incompetent." Therefore, he advises investors to look for leadership teams that demonstrate integrity, clear vision, and the ability to make long-term strategic decisions. He added, "Good management protects shareholders' interests and works to build sustainable company value." In 1963, American Express faced one of the worst crises in its history, a scandal known as the salad oil swindle. A supplier had fraudulently used barrels filled with water, topped with a thin layer of salad oil, to secure loans from several companies, including American Express. When the fraud was uncovered, the company's stock plummeted. Confidence in American Express evaporated almost overnight. But Warren Buffett saw something others didn't. Instead of running from the chaos, he leaned in. He personally visited restaurants, shops, and businesses that relied on American Express and asked them one key question: "Are your customers still using the card?" The answer? A resounding yes. People still trusted the brand. The scandal hadn't damaged the core business, only the headlines had. Buffett later said. 11. Discipline and wise decision-making. Buffett concludes by emphasizing that discipline is the key to successful investing. He says, "You'll face many opportunities, but most are not good. The ability to say no is your most important skill." He offers an analogy of having 20 punches in your investment life, meaning you get 20 chances to make smart decisions and generate real gains. Each decision must be based on deep understanding, not market pressure or emotion. He stresses long-term thinking and investing as if you will own the company for 10 years or more. He often asks himself, "Would I buy this stock if I couldn't sell it for 10 years?" These questions help focus on real value and avoid short-term losing trades. Start investing like Warren Buffett today. Subscribe, like, and share this video to empower others on their journey to financial freedom.